Right, hi Jeb, welcome back.
Hi,
Ready?
Anthony. Yeah. Yeah, I can hear you. Can you hear me?
Yeah, I can hear you. Can you see the screen? I've shared it.
Yeah, I'll come up.
Okay, perfect. Okay, so yeah, this is part 2 now. We're obviously looking at the long questions, and this is where you'll get most of your marks. You can see if we look at the May-June 2017 paper, section B counted 50. That's a lot. Okay, and you've got 2 questions, one for 25 and another for 25. The nice thing about this question, I was looking at it just now, and I see they've split it into 3 sections. Okay, 1.1, 1.2, and 1.3. Right, and that obviously makes up the 25 marks. You'll see they ask you about WACC here. They ask you for the proposed capital structure. They also look at the earnings per share, the EPS. And then at the top here, they're looking at the number of shares.
Yeah. I'm ready.
Great. So now, if we look at question 1, there's things that we need to highlight, circle, underline, where we've got important bits and pieces of information. So if I read it, so this is the approach. You go to your question and you see what you've been asked to calculate. So number of shares is the first bit. EPS is the second bit, and the last bit was obviously the WACC, weighted average cost of capital.
Yeah.
So you should have those things at the back of your mind. When you read the information, you need to get a sense of what they've given you in the question. There's not a lot to work with here, so you'll see when we approach it in terms of the written answer.
Do you have to work out the one before you can find the others?
Sometimes, not all the time. Sometimes they are separate.
Okay.
So let's read it and let's make a note of the things that are important. Right, what I like to do is, because remember 25 marks is what's allocated. No one knows where we're going to be getting the 25 marks. Obviously it's split into 5 and then 10 and then 10. So when looking at something like number of shares, generally you'd be taking information from the question and you'd be putting what's important there in terms of calculating the number of shares. So when I read the first bit, they say a total equity finance company with with 10,000 ordinary shares, each with a book value to market of 35 Rand.
Yeah.
Okay, so is there anything important there? Yes. Well, the first thing is totally financed through equity. So 100% equity.
Okay.
We know that the company has 10,000 shares worth 35 Rand each. So 10,000 times 35 would be the market value of the company.
Okay.
Then we also know that it's in the process of introducing debt. There's something important. We know we're wanting to introduce debt. Okay, just to go back to theory. If you introduce debt into a business, you should be able to maximize the return. So your EPS we would expect to increase, okay, with the introduction of more debt. And the reason for that is because debt is tax deductible. So you get a tax benefit by introducing debt. If you raise more finance through equity, there's no real incentive or benefit for doing that, other than not having to pay back the shareholders, unless you what's the right word? Redemption. Okay, when shares are basically sold or bought back by the company. So remember, with equity, shares can be held indefinitely. With debt, there's normally a clear end point. For example, a bond has an end point. A loan has an end point. Debt would have an end point. Okay, so a start and then an end. That's why we have a future value or a par value. Then we've got capital here. In terms of the structure, we know that funds are raised through debt will be used to retire some of its shares. That's important. Right, so if you're raising debt, you're not going to have the same amount of equity. Right, you're going to be paying off some of the shareholders because you're now going to be raising capital through debt. That's what they've told you in the question. Right, so that says that the number of shares will change. And we kind of know that already because question 1.1 talks about that. They say calculate the number of shares under each proposed capital structure. Right, so there'll be a different amount of shares under each proposed capital structure. Then they say the company pays all its earnings as dividends. That's very important. Because now you know that the earnings are paid out as dividends.
Yeah, so there's no retained earnings.
There's no retained earnings, exactly. Right, so your payout is 100%. Payout ratio is 100%.
Okay.
Subject to a 29% tax rate. The expected sales are 630,000. Sales is part of the income statement. That's income. Okay, we'd be determining the EPS. Okay, we saw that earlier when I looked at the required. EPS is earnings per share. Okay, that information needs to come from the income statement.
Yeah.
Okay, or the statement of comprehensive income.
Yeah.
So those are the type of things you should be thinking about when you read the scenario. Okay, either make notes on the question or make notes on your actual answer book, but make notes. Okay. Then they say the fixed costs are 270,000 and the variable costs are 35% of sales. That I can work out because I've got the sales, so I can work out 35% of the sales.
Okay, Anthony, just a quick question. I mean, if there's 10,000 outstanding ordinary shares, even if they were going to increase even if they were going to introduce debt, why would that affect the number of shares in the actual business?
Because you would retire some of those shares. Because remember, shareholders own equity in the business.
Yeah.
So now, if you've got 350,000, that's the total financing in the business. Let's write that down.
Okay. Would they always do that, though?
Not always. It depends on the question.
Okay.
Companies have different objectives. Companies do things differently. This company is choosing to do this. Okay, 100% equity. What they want to do is introduce debt.
Okay.
Pay off some of the equity holders or equity shareholders and raise the required funds with debt.
Yeah. Okay.
Right, so that 350 is very important because the 350 basically tells you how much equity is required to finance the business.
Okay, so with the fact that they're asking, so if we can just go back to the question quickly. Okay, so with the fact that they calculate the number of shares to be purchased under each proposed capital structure, would that be an indication that they're going to reduce the amount of shares?
Yes, of course, because you're going to be paying off some of the shareholders, and then you wouldn't need as many shareholders in the business because you're going to be raising more debts.
Okay, cool, 100%.
Okay, then you've got two different scenarios. There's actually three. Okay, there's capital structure A, capital structure B. Okay, if I go with A, I'm going to use 55% as a debt ratio. Right, you still need to know your ratios from FIN3701. And that's why in the first set of notes, I've actually given the ratios because you can't overlook them. You still need them because something like this is required because you need to identify how much debt, how much equity. Okay, so we'll discuss that again later. Then we see that the loan is provided by FNB at 13%. Right, then we've got capital structure for B, 35% debt ratio. And we've got a loan by Nedbank at 15%. Right, so that's what we've got currently. Right, so now we need to approach the question. The first thing we need to do is obviously calculate the number of shares that will be purchased under each proposed capital structure. Right, so what must we do? We need to do some analysis. Okay, so let's draw up an answer. Okay, so 1.1. Basically, they want you to work out how many shares. Okay, so there's actually three scenarios. Obviously, the first scenario is what? 100% equity.
Yeah.
If there's 100% equity, this would have been now
10,000 shares. Yeah. And that's 10,000 shares.
Yeah, we'll put that in just now, and then obviously 0 debts.
Okay.
Okay, so I'm building an answer. This is how I would do it if this was the exam. Okay, and then capital structure A, capital structure B.
B. Okay.
Right, they tell you debt ratio equals for A
It's 55%.
55 and then 35 for B.
Yeah.
Okay, so we need to go back to slides number 1 and we need to get the debt ratio. We need to write it down. Here's the debt ratio. Copy, paste. Okay, so that's the debt ratio from FIN3701. Now I've got it. Alright, so what does that mean? Well, that means I've got liabilities to assets. So if the debt ratio is 55% of the assets, that means the equity will be the difference. So how much equity does this company use in this company capital structure? 45%.
Okay.
Here, it'll be 65% equity.
65 and 35.
35% debt. Right, so the first thing we need to obviously look at is the total market value of the business. How much finance does the business require?
Well, it depends on the amount of debt ratio that they want.
No, but finance, how much they want? It's in the question.
350,000.
Yes, okay. Is that going to change?
No.
No. Okay, they said they're going to retire some of the shares, and they said this. Maintain the same amount of financing. That's very important.
Okay. Okay.
So 350 is needed there, 350 is needed there, 350 is needed there. Do you agree?
Yeah, 100%.
Okay, so if I've got 350, how much is debt, how much is equity?
Okay, so in the current one, it would be all debt. I mean, all equity would be all equity. In the second one, 55% would be debt, and in the third one, 35% would be debt.
Yes, exactly.
With 45 and 35 being, or 35 and 65, sorry, being debt, equity, and equity.
Yeah, exactly. That's right. So yeah, so value right, so yeah, this is 100%, so 100 there, 0 here. Equity here was 45, so 350 times 45%.
Yeah.
350 less that would be the debt.
Yeah.
Times 65.
Yeah.
And the difference would be the debt. Does that make sense?
100%.
Okay. Right, so now we need to look at the number of shares. Okay, obviously share price is how much? 35 Rand per share.
Yeah, 35 Rand.
Yeah, the only problem with this question is you would have to assume that the share price stays at 35.
Yeah. Yeah, look, sorry, Anthony, I didn't print this exam, so if we can just maybe just say which exams we're going to do, which exam we're going to do in the next couple of lessons. I've got all of them printed except for this one, to be honest.
Okay, yeah, that's fine. If you've got all the others printed, that's great. Sure. Obviously, I wanted to do the most recent exams first, and then just go back in time. Yeah.
Actually, I just actually forgot to print this one today for some reason.
Okay.
So that's why we just need to keep referring back to the question, because I don't actually have it in front of me.
Okay. So what was the price per share? We read it. It was 35 Rand.
Yeah.
Okay. Market value of the share price is 35 Rand. The point I was making is we will assume that this remains constant, that this doesn't change. Obviously, in reality, share prices change every day.
Yeah, but they would actually tell us if it did change. So
they would have to tell you, because you wouldn't be able to do it if they didn't.
Yeah, 100%.
Okay. So yeah, that's an assumption that we would have to make, and that's why I mentioned it here. So even if this was a written paper, I would have even wrote that. I literally would have written this down. Everything I'm writing here is everything I would write in the exam. Okay, nothing here is something that I won't write. So that's the approach that I'm taking. So whatever I have here is exactly what I would write down, because remember, you don't know where UNISA is going to give you marks. Are they giving you marks for theory? Are they giving you marks for calculations? We don't know. So the thing is, the right technique, the right approach is to give as much as possible, even to state the obvious. I mean, this was given, okay? This was given, but I wrote it down. 35 Rand times 10,000 shares. Okay, you need to show things like that, because there may or may not be marks allocated for it.
Yes.
Okay, so that's just something to remember in the actual long questions. Just write as much as you can, take as much as you can from the question.
Reminds me of high school maths.
Kind of, but it's not maths, because it's more application of the theory.
I'm just saying that all the steps. Like you don't just...
The steps...
Yeah, you show as much information as you can.
Yes,
is what I'm saying in relation to maths. Yeah, okay.
No, I hear what you say. Yeah, definitely. So just cover yourself as well in terms of the exam, because you don't know where the marks are going to be given, and that's the only problem with a question like this, is that 5 marks are being allocated, but we don't know where. So the rule of thumb, or the tip, would be just to even state the obvious. Something as simple as this: 35 Rand per share times 10,000 shares. I mean, that's in the question. Don't just write this, actually show the working. So I should have written that next to that, actually.
Yeah, okay.
Alright, so assuming that the shares are still worth 35 Rand a share, how many shares are we going to have here? 10,000.
So there would be 3,500. Well, there would be 10,000 there, but 4,500 in option A, and 6,500 in option B.
Let's work it out.
Yes.
4,005, yes.
So 4,500 and 6,500.
Yes. Okay, now you've answered question 1.1.
Okay, cool.
That's what they wanted. The question said calculate the number of shares to be purchased under... Oh, to be purchased. Be careful. Not to be issued.
Yeah. So then it would be the opposite. So it would be 55, 5.5 and 3.5. Yeah, cool.
Right, so yeah, that's right. 55 and 35. Okay, now we've answered the question.
Cool. Would you put a negative or a positive?
It doesn't matter, as long as you state that these are the shares that you're going to buy.
Yeah, okay.
Okay, so if you want to make it negative, go for it. If you don't, it doesn't matter. A positive is fine. Let me make it a positive then.
Yeah.
Okay, next question. Calculate the earnings per share for each proposed capital structure. Right, so exam technique. When you see this, what do? You write down the formula always. You don't not write down equations because you never know, there might be marks for it.
Yeah.
Okay, so stick to the good exam technique from FIN3601. Write down the EPS. Okay, so let's go back to our formulas. Let me get EPS. Here's it. I'll write it down.
Profit for year minus preference share dividends divided by number of ordinary shares issued.
Yeah, okay. Alright, so I'm going to keep the same format. We had this earlier. I'm just going to copy and paste that.
Yeah.
Alright, so we've got now, we've got A, we've got B. Okay, these are all separate. Alright, so what do I need to calculate EPS? Profit for the year. Do I have that?
Not directly offhand, but we can work it out.
Exactly.
From some of the stuff in the question.
You don't have the profit, but you can calculate it because they tell you what the sales are, they tell you what the fixed costs are and the variable. And they also tell you that you pay out all your earnings as dividends.
So is profit for the year is that after tax?
Profit for the year is after tax, yes, it has to be.
Okay.
Yeah, so you have to take tax as well.
Sometimes, it's just sometimes you have different types of profit. So
sure, yeah, operating profit, net operating profit, profit before, profit after. Yeah, I know what you mean. Yeah, I know what you mean. Okay.
Okay.
All right. So sales. How much were the sales? 630.
Yeah. Cost 270.
Okay, fixed costs
was 270.
Yes, 270.
And variable cost was at 35%.
35% of sales. Okay, so
it would be 630 times by 35.
right, so yeah, that's the variable cost, so we've shown that. Okay, then you would have, let's call this EBIT, earnings before interest, tax, and...
Yeah.
Alright, so that's going to be...
So what you would essentially do with this is build, I mean, you could basically, after your fixed cost or your variable cost, you could possibly have straight after the sales, because that could possibly be your cost of goods sold, which would give you your GM or your GP, and then you could have your variable costs or your fixed costs, which would then give you your EBIT. Then you'd have your interest based on the different structures.
Yeah, you can structure it however you want, as long as you've included the correct amounts to do the right working. That's fine. If you want to structure it more specific in terms of accounting, by all means, go for it if you want to.
No. I just want to just think about it. So I mean, basically, what we're doing is we just are structuring really just a normal income statement.
Yes, because you want what? Profit.
Yeah.
Correct.
100%. Okay.
All right. So now we need to take off the interest. Okay. How are we going to work out interest?
So on the first one, there would be zero.
We are going to need to calculate the debt. Okay. So debt finance here was 0. Debt finance for A, we worked it out earlier. There's it.
It's 55%. Yeah. And then there were two different interest rates though that they used.
Yeah, of course, we need to insert that now.
Yeah.
Interest rate for FNB 13%.
Yeah, and then the second one was 15%, I think.
Yes. Okay, so how much interest is this business going to have to pay? Well, this times 13%.
Yeah, and that times by 15%. Okay, and then you would take that off your profit to give you your profit before tax, or your EBT. So that would just be that. Yeah. Cool.
Now what?
And then you take your tax off. You have to take your tax off each of them.
Yeah, what is the tax rate? Let's go back 29%.
29%, yeah.
Okay, so that's the tax. So now the profit for the year
would be Could that also be called net profit?
You could if you want to, but I'm just using the same vocabulary as the formula.
Just in case they just throw some other...
Yeah, it wouldn't matter what you call this because it's part of the calculation for EPS.
Yeah.
Okay. All right. Now what do we need? The preference share dividend is 0. We would state that.
Yeah. So it would be that divided by 10,000. It would be your net profit divided by 10,000 for each of them.
No, not for each of them.
Oh no, it wouldn't. You're right. Yeah. So the first one would be by 10,000.
Okay, so the shares here were there.
Yeah, 10,000 and then 4,500, or was it? Yeah.
Okay, so
and 6,500. Yeah. Yeah.
EPS is this divided by that.
Yeah.
Okay, is that in line with the theory?
Yeah, it is.
Why?
Because
you would expect the EPS to go up with more debt. Okay, because debt is leverage. This is a form of leverage.
Yeah. Well, your earnings per share would definitely go up because not all of it's fine. Because of the interest, because interest being tax deductible, it would make the share prices higher because you would have, especially if you're buying shares back with debt. So you've got less shares where there's less money being paid, if you know what I'm saying. Well, there's less profits coming from it. So your profits are higher according to less shares. I mean, even if the shares stayed the same and they just introduced a portion of debt, it would still increase the earnings per share because your profit for the year would still be less your debt.
Yeah, it's that whole ROE debate where if you introduce debt, you add leverage and that maximizes profits. Yeah, so we looked at that as well in FIN3701 as one of the examples.
Yeah.
Maximizing profit. Okay, good.
Okay.
All right, so was that the question? Let's check. Calculate the earnings per share for each proposed capital structure. Done.
Cool.
1.3. calculate the WACC for each proposed capital structure. Okay, so...
Okay, so the WACC would be what the capital structure is times by its weighting.
Yeah, I'm going to get that from before. I wrote a formula down. I'm going to copy it.
Yeah.
Alright, so this is 1.3.
Yeah.
I'm going to still need the same headings.
Yeah.
Okay, and I'm going to do 3 separate calculations. Alright,
Yeah.
so weighting of debt and equity. Okay, let's get the total finance that we had earlier. Where was that? There's it. I want this.
Yeah. So
Okay,
this
that's
would be
not
a
gonna
question
change.
you would have to work out first in order to actually get to the final answer.
Yeah, but remember the weightings are actually
Because you
given
wouldn't
here.
get...
There's the weightings.
Yeah, but I mean, you wouldn't... Yeah, you would have to still work out the profit and stuff, though, wouldn't you?
You'd have to work out the cost of debt and the cost of equity, yes.
Yeah, and I mean, if the cost of debt is after tax, you'd have to do the calculation in the one before.
Yes, of course.
At least before you did, yeah.
Okay, cost of debt here, 0. Cost of debt here, we saw it earlier. Where was it? 13%.
No, it was, 13 and 15, I think.
Before tax cost.
Yeah, it was 13 and 15.
After tax cost. Okay, so how do I get the after tax cost? I take the 13 and I multiply it by 1 minus the tax rate of 0.29%.
Yeah.
Gives me that. $15 gives me that. Okay, there's the after tax cost.
Yeah.
Okay, now I need the cost of equity. How am I going to get that? Any idea?
Well, wouldn't you times the equity times by the value of the equity? So whatever equity is left. So if you've got 45% of equity, you take 45% of the 350,000, or wouldn't it be I don't know.
Okay, almost. What is the cost of equity?
Isn't it the percentage return that's required?
No, it's the payout that you make.
Okay.
So it's the dividends.
So are there dividends? Did they mention dividends?
Yes, they did.
Okay.
Okay, so the cost of equity is dividends.
Which is 100%.
Yes, in terms of your earnings.
Earnings. Okay.
Okay. So let's write that down.
So on the first one, it would be the total profit, basically, which was I can't remember.
Okay, so EPS of the 1 was that.
Yeah.
There's your EPS.
Okay.
This is the DPS because 100% is paid out.
Yeah. And which is the dividends per share. And that would be divided by whatever the share amount is. So in the first one, it would be 10,000.
Yeah, the cost of equity. No, the cost of equity will be divided by the share price.
Okay, by the share price. Okay.
Yeah, because remember the price was 35.
Okay, yes, okay.
That divided by 35 for all of them.
Yeah.
Okay, so there's your cost of equity.
Okay, for shares. Yeah, for the cost of equity. Okay, so then you would take, so then for the first one, there would be, it would basically 0 plus 100 times, so your first one would be 28, would be exactly what that answer is there.
Yeah, so WACC for 0 debt.
Yeah, and it would be whatever the equity amount is, which is 28 point. But I mean, wouldn't the weighted cost of capital then be 100% on the first one for equity?
Yeah, well, 100% of your cost. So it is the cost.
Yeah. Okay. Okay. Yeah. Okay.
Does that make sense? Is that alright?
Yeah.
Okay. Then we need to do the same thing for the other one.
Then the next one would be obviously
55%.
Why is the one in the percentage? So is this so 28% of the cost of equity? So the cost of equity in the first option is 28%, 51%, and 37%.
Yeah, for the 3 different options. Those are the options.
Yeah. Just for the equity portion.
Well, equity is that's the cost of equity. There's the cost of equity.
Yeah, but is that a percentage, or is that, because if we're working with percentages up in the cost of debt, surely we must be working with percentages in the cost of equity.
Yeah, it's always percentages.
Okay, no, I was just checking that.
Yeah, these are percentages. Right, so cost of debt, 55% times the cost. What is my cost of debt? After tax, 9.23.
Yeah.
Then here, we had 45% of 51.6046.
29%. Okay, yeah. Okay.
Right, that's that one.
Yeah.
And then
They're so much alike.
Very similar, yeah.
They're almost exactly the same.
Almost, yeah.
Actually, they are pretty much exactly the same.
There might be more decimals here, but I didn't put in so many decimals.
Yeah. Put a couple of extra decimals so it looks the same as the top one.
But then I'm
Just
going to
for
have to change
interest sake.
this number.
Okay, no. Okay, yeah, don't worry about it. It's almost exactly the same.
Yeah. Okay. This one was 35% debt. 35%
Yeah,
debt.
35.
Cost
It
was 10.65.
And then the share was 65%. See, now that's the type of answer that would freak me out, though. Like,
what's wrong?
That's the type of answer that would freak me out, though. Like, because if you got to the same, because those two are almost exactly the same. I mean, going down to the last decimal places you have, the ones are 4 and the ones are 3.
Yeah,
like, I would think that there was something wrong.
Oh.
Yeah, I know, but I mean, I would just think that there was something wrong there.
This one's actually very similar
and I mean,
as well.
look at that one. They're all exactly the same.
Yeah, well, they're different workings, but the answers come out the same. So, yeah, it's just coincidence.
But now, I mean, do you know how many people would be sitting in an exam and looking at that and thinking, like, this can't be right?
Well, yeah, I mean, it is what it is, eh? We're just doing the calculations as is, yeah.
Yeah.
Okay, but obviously remember,
I'm just saying
marks
one of those
aren't
things
probably going to be given for this. So remember, marks aren't going to be given for this. Marks are going to be given for that.
Yeah.
So make sure you have that.
Yeah.
Because that's where the marks come into it. Whether the answer's the same or different actually makes no difference. But
they must be giving you an answer for the answer, though.
Yeah, you'll probably get maybe a 1 or half. You're not going to get 10 marks for just saying, well, all the whack is that, now give me 10 marks. They're not
no, 100%.
Yeah.
But I'm just saying, like, from an example, if I to come up to those answers, now that I'm working it out with you and I can see exactly how it's done, but if I came to that in an exam, I would be seriously doubting that I got the right answers.
Okay. Well, don't doubt yourself if you've done it correctly.
Yeah. The problem is I wouldn't know if I...
Yeah, but I hear what you say, yeah. Okay.
Yeah, I mean, that's a little bit slow then to do something like that. You have the answers
I don't think it was
planned,
eh? I don't think any examiner that sets a paper plans to have an answer that's the same. I think the numbers, like purely out of coincidence, worked out to be that. So I guess it can happen, but I don't think they initially planned for that to happen. Yeah, but that was what we did. Calculate the WACC for each proposed capital structure, done.
Yeah.
Okay, there's the workings for all of them, having done the separate calculations prior. Okay, is that alright? Questions about that one? Happy?
It's just so weird that they're exactly the same, though.
Yeah.